You just lost someone you love. You're grieving, you're exhausted, you're trying to figure out funeral arrangements, family drama, all of it. And then somewhere in the middle of that chaos, someone hands you a bombshell. You've inherited a house. A whole house. And before you can even process what that means, your accountant calls and drops this on you. You need to sell it within 6 months to a year, or you're going to owe capital gains taxes on the entire thing. That's what happened to a woman who signed her letter blessed and confused. And honestly, that name says everything. Because she's sitting there with a family home, a mortgage still attached to it, a plan to sell it to a family member at the appraised value, and now she's panicking because her CPA planted this seed of fear that the clock is ticking. Here's the thing. Her accountant is wrong. Not a little wrong, significantly wrong. And this is the kind of wrong that costs people real money. The kind of wrong where someone rushes a sale or sells to the wrong person at the wrong price because they thought they had a deadline they never actually had. Hello, I'm Anne. Welcome to my channel. This video is for educational purposes only and does not constitute legal, tax, or financial advice. Let's get right into it. So today, we're going to fix this. We're going to talk about what actually happens when you inherit a house, why the step-up in basis might be the most powerful tax concept you've never heard of, and what your CPA absolutely should have told you. Stick with me on this one because if you or anyone in your family will ever inherit property, and statistically speaking, that's most of you, this is going to matter. Let's start with the bad advice first, because I want you to understand just how common this mistake is. There is no federal law, none, zero, that says you must sell inherited property within 6 months or a year to avoid capital gains tax. I need you to hear that clearly. No such rule exists under federal tax law. Your CPA either misread something, misspoke, or honestly doesn't fully understand how inherited property is taxed. And look, I'm not here to bury the man. CPAs are human. They're often juggling dozens of clients, and inherited property has some genuinely nuanced rules. But this isn't a gray area. This is a clear, fundamental misunderstanding of how the tax code works. Now here's what probably happened. There is a concept in estate law involving a 6-month alternate valuation date. After someone passes, their estate can choose to value assets either on the date of death or 6 months later, whichever results in a lower estate tax liability. That's a real thing, but it has nothing to do with whether you owe capital gains tax on a future sale. It's a valuation election for estate purposes, not a sell-by date. Somewhere along the way, that concept got scrambled into you have to sell within 6 months or you'll owe capital gains on everything. And now this woman is freaking out unnecessarily. This is why financial literacy matters. Not because you need to become a tax attorney, but because you need to know enough to recognize when something doesn't sound right, so you can push back, ask questions, and, when necessary, get a second opinion. All right, let's talk about what's actually happening here. And I want to use a metaphor because this concept trips people up every single time. Think about your basis in a property like the starting line of a race. When you buy a house for $300,000, your basis is $300,000. That's where you start. If you later sell it for $500,000, your gain is $200,000, the distance you traveled from that starting line. That's what gets taxed. Now here's what changes when you inherit property. The tax code does something remarkable. It picks you up and moves your starting line. Instead of inheriting the original owner's starting line, your basis gets stepped up to the fair market value of the property at the time the person died. This is called a step up in basis, and it is one of the most generous provisions in the entire tax code. So let's say your parent paid $200,000 for a home 30 years ago. When they pass, the home is now worth $800,000. If they had sold it, they'd owe capital gains on $600,000. But when you inherit it, your new starting line is $800,000. That's your stepped-up basis. If you turn around and sell it for $800,000, even 6 months later, even 2 years later, your gain is zero. You owe nothing in capital gains tax. That's it. That's the magic. And that is exactly the situation our blessed and confused writer is in. She had the home appraised shortly after the family member's death. That appraised value is her stepped-up basis. If she sells it to her family member for that same appraised value, whether it happens at 5 months, 12 months, or 24 months, she owes no capital gains tax on the transaction. The clock she thought was ticking? It doesn't exist. Now let me make sure you fully understand what stepped-up basis means in practice, because a lot of people get tripped up on the details. First, the appraisal. When you inherit property, you should, and this is genuinely important, get the property professionally appraised as close to the date of death as possible. This establishes your basis. If you wait too long to get that appraisal, it becomes harder to document what the fair market value was at the time of death. Our letter writer did this correctly. She had the home appraised within weeks. That's exactly right. Second, the sale price. If she sells to her family member at or near that appraised value, the taxable gain is essentially zero. If she sells it for more than the appraised value, there would be a taxable gain, but only on the difference. So if the home was appraised at $400,000 and she sells it for $420,000, the potential gain is $20,000, not $420,000, not the full sale price, just the $20,000 above her stepped-up basis. Third, and this is where the CPA should have been more helpful, inherited property is always treated as long-term property for capital gains purposes. Always. Even if you sell it the day after you inherit it. That matters because long-term capital gains rates are significantly lower than short-term rates. Short-term gains are taxed at ordinary income rates, which can hit 37% for high earners. Long-term capital gains rates are 0%, 15%, or 20% depending on your income. So even in a scenario where there is some small gain above the stepped-up basis, you'd be paying long-term rates. The law is actually pretty generous here. I want to pause here and bring up something that affects a different group of people. Those of you who might be thinking about adding your children to the deed of your home while you're still alive. This comes up constantly, and I understand the instinct. You think, I'll just put their name on the house now, avoid probate, make it easier. And look, I get it. Estate planning conversations are uncomfortable. Nobody wants to sit around talking about who gets what when you're gone. But here's the problem. When you add someone to the deed while you're alive and then they eventually sell the property, they don't get a step up in basis. They inherit your original basis, the old starting line, not the new one. So if you paid $150,000 for a home that's now worth $700,000 and your child's name is on the deed when you die, they're looking at a potential capital gain of $550,000 when they sell. If they had simply inherited the home through your estate instead, their basis would be stepped up to $700,000, and that $550,000 gain essentially disappears. We're talking about the difference between potentially paying tens of thousands of dollars in capital gains taxes versus paying nothing, all because of how the property was transferred. Now, I know probate is a pain. I know it takes time and costs money, but in many states, there are ways to accomplish the same goal, keeping property out of probate, making it easy to transfer, without forfeiting the step-up in basis. Things like revocable living trusts, transfer on death deeds, or beneficiary deeds where your state allows them. These tools exist for exactly this reason. Talk to an estate planning attorney, not just a CPA, about the best approach for your situation. The right structure can save your heirs a significant amount of money. Now let's talk about the scenario where capital gains tax would actually apply, because I don't want you walking away thinking inheritance means you'll never owe anything. Context matters. If you inherit a home and then live in it and genuinely make it your primary residence, you might eventually qualify for the primary residence exclusion. That's the rule that lets single filers exclude up to $250,000 in capital gains, and married joint filers exclude up to $500,000, but only if you've owned and lived in the home as your main residence for at least 2 of the 5 years before the sale. This is a great benefit, but it has nothing to do with the 6-month deadline myth the CPA mentioned. The scenario where you'd actually owe capital gains on an inherited property is if the property appreciates significantly after you inherit it, meaning you hold it for years, its value grows beyond your stepped-up basis, and then you sell. In that case, yes, you'd owe capital gains on the appreciation that occurred while you owned it. But again, it would be long-term capital gains rates, and it would only be on the gain above your stepped-up basis, not on the full sale price. And what about the mortgage? The letter writer mentioned the home still has a mortgage. Here's the simple answer. The mortgage has absolutely no effect on how capital gains tax is calculated. Zero effect. When you sell the property, the mortgage gets paid off from the sale proceeds. That's just how the transaction works. The lender gets their money, you and the other heirs split whatever's left. But the IRS doesn't care about the mortgage when calculating your taxable gain. They only care about the sale price, your basis, and eligible selling expenses. The mortgage is a cash flow issue, not a tax calculation issue. Okay, let me bring this back to the original question one more time because I want to make sure it lands. Blessed and Confused inherited a home. She got it appraised. She wants to sell it to a family member for the appraised value. Her CPA told her she has to do this within 6 months to a year or she'll owe capital gains tax on the entire sale price. The CPA is wrong on every meaningful point. There is no federal 6-month or 1-year deadline. The sale price is not what gets taxed. The gain above the stepped-up basis is what gets taxed. And in this case, that gain appears to be approximately zero. The timing of the sale, as long as it's at or near the appraised fair market value, does not change the tax outcome. She can take her time. She can do this right. She can sell to the family member when it makes sense for both of them, at a price that reflects fair market value and owe nothing in federal capital gains tax on the transaction. The only thing I would caution is this. Make sure the sale to a family member is done at arm's length and at fair market value, and that you have proper documentation. The IRS looks closely at below-market sales between family members. If you sell a $400,000 home to a cousin for $200,000, that discount can be treated as a gift and create gift tax complications. Selling at appraised value? Clean, documented, no problem. Here's what I really want you to take from this, and I mean this genuinely, not as a scare tactic. Most people trust their advisors completely, and that trust is usually warranted. But financial professionals, CPAs, financial planners, even attorneys, are not infallible. They have areas of deep expertise and areas where their knowledge is thin. Inherited property taxation sits at the intersection of estate law and income tax law, and it trips up a lot of generalist CPAs who don't work with it regularly. You deserve an advisor who either knows this stuff cold or is honest enough to say, "Let me look into this more carefully," instead of confidently dispensing advice that could push you into a rushed, unnecessary decision. A rushed sale of inherited property can mean selling below market value, missing a better offer, or making a family situation more complicated than it needs to be. The stakes are real. So what do you do? First, if you're in this situation or expect to be someday, ask your advisors specifically about step-up in basis and inherited property. Watch how they respond. Do they light up with confidence? Do they give you a clear, accurate explanation? Or do they get vague and give you a general rule that doesn't quite add up? Their answer tells you a lot. Second, if you have inherited or expect to inherit significant property, it may be worth a one-time consultation with a CPA or tax attorney who specifically works with estate and inheritance tax matters. Not your family's general CPA who does your taxes every April. Someone whose specialty is exactly this. The consultation might cost you a few $100s and save you tens of thousands. Third, learn the basics. You don't need to become a tax expert, but knowing what a step-up in basis is, knowing that long-term capital gains rates apply to inherited property no matter how long you hold it, knowing that there is no mandatory sell-by date, that baseline knowledge is your first line of defense against bad advice. Here's the bottom line. The tax code, for all its complexity, is actually quite generous when it comes to inherited property. The step-up in basis provision is designed to prevent families from being crushed by capital gains taxes on assets that appreciated over decades under someone else's ownership. It's one of the rare instances where the law genuinely works in regular people's favor. Don't let fear, misinformation, or a well-meaning but mistaken advisor push you into a decision that doesn't serve you. You are not racing against a clock that doesn't exist. You inherited something valuable. Take the time to understand what you have, document it properly, get the right advice, and make the decision that actually makes sense for your family. Blessed and confused. You're more blessed than you know. And now, hopefully, a little less confused. If this helped you understand something you weren't sure about, share it with someone who might need it. And if you've ever gotten advice from a financial professional that later turned out to be wrong, drop it in the comments, because this community learns from those stories just as much as the success ones. We'll see you in the next one.